Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
Somehow it came up about dad jokes. And like, tell me your favorite dad joke. And that's the one I went to. Too tired.
He's got to go back. All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. Today, we are going to be talking about RMDs, or what I like to think of as raisin mutation diseases. Well, I mean, not really. It's actually required minimum distribution, but, you know, I tried to come up with something that was way more entertaining than that.
But
so,
isn't a raisin already a mutation of a grape? So like,
it's like it's a super sad grape.
Yeah.
But this is really a follow-up to our other recent episode where we talked about account types, and we actually kind of left the conversation off without going into too much detail about required minimum distributions. So we'll link that episode below. If you haven't listened to that, check it out first, because it will kind of be a predecessor to this episode.
Yeah, because there's a lot to talk about when it comes to required distributions as well as account types, and it was hard to fit it all into one. So yeah, please listen to that first to know what accounts have to take required distributions, and then today we're going to talk about what that means.
So Josh, I hear this is one of your favorite topics in the world.
I love it because there's so many rules and exceptions, and there's one thing I like, it's exceptions to rules, because that's the most frustrating thing in the world.
That is the English language?
I before
America.
E, like that's the one that bugs me the most.
Yeah.
Like it's I before E except for almost all the time.
The English language and American law. There are lots of loopholes in both. So let's talk about what an RMD is. An RMD is the amount that a person is required to take out of a retirement account to avoid tax penalties. So RMDs are required for accounts that have a tax advantage. An example that most people could probably relate with is a 401k account. So when you add money to a traditional pre-tax 401k, you do not pay taxes on that money. So it's going in before you've paid taxes on. So it's literally like the X percent that you said or whatever of your salary taken off the top before you even are taxed by it. So if you earn $50,000 a year and add $10,000 into your 401k pre-tax, you only pay taxes on that $40,000. And that $10,000 that you put into your 401k account, it's going to grow what we call tax deferred until you take it out. And then the IRS wants to collect their taxes at that point. Right?
Yeah. So tax deferred, meaning you're deferring, you're putting it off. It doesn't mean you get out of taxes.
There's no free lunch.
No, but you're just saying, I'll pay you later.
It's an IOU.
And the IRS says that's fine because every dollar that grows to, you're also going to pay tax on.
And taxes are probably going to be higher in the future.
That's what they're thinking. So, but that's the idea is, and this is the end result of that, is the IRS says you can only defer taxes for so long. And so at some point, we want to collect that tax money because that's what keeps everything going in government.
Yep.
And so they put restrictions on that. So the RMD, which is just, exactly as it sounds, required minimum distribution. So they're saying, here's the the least amount you have to take out of your account each year. It's required.
So how did the IRS decide how much each person has to withdraw? And does everyone owe the same amount, or how does that work?
Yeah. So to make it fair, the IRS says, okay, they're going to force a minimum withdrawal starting at a certain age, and then from then for the rest of your life, and they're going to do that as a percentage because everybody has different account values.
Gotcha.
If they said everybody owes $10,000, for one person that may not matter, for another person that might be their whole account, and then they're done. So they said, okay, we're going to do it as a percentage. And up until last year, so 2019, they passed a Secure Act, which changed some stuff. But prior to that, 70 and a half. Because, let's make things as confusing as possible. We're going to do the favorite half year shows up. Your first required distribution is in the year you turn 70 and a half.
So everyone in their calendar had their 70 and a half birthday marked.
I mean, who doesn't celebrate their half birthday every year?
That's another excuse for ice cream.
I guess.
Now, you don't really eat ice cream, but if you did, it would be
on the half year, yes.
You could have sorbet.
Yeah, that would be true. Or Dole Whip.
Sorbet keeps you from having a sore tummy.
Yes, that's true.
Okay, that's good. Josh has a lactose issue. So
yeah, I don't eat ice cream.
For listeners. So yeah, the famous half birthday the government loves to use. Yeah. Totally ridiculous. So, starting in 2020, they have a new age for that.
Yep. And so now it's 72.
Oh, that feels so
the thought
much
process
better.
was people are living longer, life expectancy's been growing, that we're going to start at 72. An easy number. Everybody knows when they turn 72, they don't have to run some weird calculation.
You're already thinking about the rule of 72. Yes. 72. Man, okay. I love it. 72 is the new year. Easy to figure out. So you mentioned a table.
Yes.
So does that table tell you the amount that you have to withdraw?
Yeah, so the IRS puts out this table, and they say, okay, based on life expectancy, they give you a number, and this is the factor you use to figure out how much you need to take out.
I like factors.
And this factors into the calculation. Yeah, got it. Yeah. So they say, okay, if you are 72 years old, you take the ending value of the end of the prior year. So if I turned 72 in 2021, I would take whatever my value is at the end of this year, 2020, on 12/31. That's my value. So let's say it's $50,000 at the end of the year. All right. And then I turned, we're going to say 76 because I actually looked all these things up. All right. So if I turn 76 in the next year, my factor is 22.
Ooh, I don't know what that means, but it sounds good.
It's this sliding scale. The number starts high and gets smaller because you're dividing. So the smaller the number, the bigger your outcome will be.
So yeah, you have less years. The older you get, you have less years you're dividing things out by.
Yes. And so 22 is the number you're going to be dividing by. So when you divide 50,000 by the factor of 22, you come up with $2,272.73. Now, if you know have ever done a tax form, there's not places for pennies, so you're rounding. But anyway,
to the dollar,
rounding up to the next dollar. And so, $2,273 is your required distribution for that year you turn 76. And so you have from January 1 to 12/31 of that year to take the money out. Mm-hmm. All right. Now, let's say you have that $50,000 and you're 86-year-old. Your factor is now 14.1. So, like I said, it slowly starts working downward.
Yep.
All right. So that would mean you'd have to take out $3,546. So you can see the IRS says the older you get, the more they're going to force you to take out.
So, based on rough estimates of those two numbers, the IRS is using an actuarial table that assumes between 98 and 100 years life expectancy.
Actually, the table goes to 115.
Whoa.
Which is crazy. And after 115, it's 1.9 is your factor. So you're taking out over half of your portfolio every year after 115. So if you make it to 115 years old, your required distribution is over half of your portfolio every year. But again, by then the concept is you've had a lot of years to have tax deferred growth.
Exactly.
They want their money.
Yeah.
And so the older you are, the more it is required to take out. The idea there too is you just have to take it out of that tax advantage account. They don't care what you do with it once it's out. They get their tax. What's left over is yours. You could turn around and reinvest it back into the market if you don't need it. You just can't have it in a tax-deferred growth anymore. That's the only the only thing they care about.
So that is how you calculate what your distribution has to be. Now, does everyone use the same table? It's the same table published by the IRS?
Yes. Yeah, in the irs.gov, their website, you can see it. They have it right there.
We'll throw that in the show notes.
Yes, we'll have that in the show notes. That's really the best website to go to get the legal answers for RMDs.
It sounds like fun reading.
Oh, it's so great. But to answer your question, no. So there's different tables depending on your situation. And so, for instance, if you are a spouse who is within a certain years of your husband or wife, whoever passed away, and you inherit an IRA, you have a certain table. If you're past, I think it's 10 years, you have a different table. So depending on your age, when you receive the account, and how you receive the account, whether it's your money or inherited money, there are different tables. So you want to make sure you use the right table when factoring in your RMD.
So we've talked a lot about taxes because the government isn't going to give you free lunch. You're going to pay taxes on your money now, or you're going to pay taxes, as we're talking about here, down the road when you're required to take those distributions. What are some tax strategies that someone can use around RMDs? Yeah.
So let's first talk about who needs to take that out. I mean, because then you can talk about kind of this. Yeah. The idea here is people are required to take out RMD when they turn 72 for the accounts that they've been adding money into.
Correct.
Right? Okay. If you have an account that you inherit, that has a totally different rules that we're going to get to in a minute. All right. So now we're just talking about money that has that you've accumulated.
I'm getting
into.
an exception vibe.
Yes, and so that's why we had to do a totally separate episode. That's what we're doing,
we're
right?
doing episodes.
Let's do an episode of this. A totally different episode is that there's so many rules, situations, because really there's a rule because some situation popped up and someone asked the question and they had to come up with a.
I know the first person who ran into that situation probably skated through, tax-free or whatever, and then the government's like, I gotcha, we're not letting that happen
and
again.
Probably why it's 59.5 is they had a friend who was connected in the government and said, hey, you know what? If I could push this off a little bit farther, let's do 59.5.
I need 6 months. I just need 6 months.
No, it's so ridiculous. But from a tax strategy around RMDs, people who have their own, that at 72.5, you can do things to lessen the burden by first reducing the amount of money in those type of accounts.
Yeah.
And so there's a lot of 401ks now, they have the option for a Roth IRA, a Roth 401k. And so you could add money in, and that's after-tax money. And since the money's already been taxed, the IRS does not require distribution out of that account. So one way to do it is to put more money in tax-free accounts, like a Roth IRA or a Roth 401k, post-tax, it grows tax-free. Or you can convert later on, meaning move money from a tax-deferred account like an IRA or 401k into a Roth IRA, and you would pay tax at that point, but then no future RMDs are required.
And I'm sure that a financial advisor would have a pretty good way to calculate the optimum point and amount to be able to do stuff like that.
Because then you get into, okay, what tax rate am I
now
paying as opposed to what I'll pay in the future? Is my required distribution going to be a burden for me? Maybe I'm already planning on spending that amount of money every year, so I will be taking out anyways. Yeah. So there's a lot to consider, but that is a way to reduce that required distribution. The other way is when you do have required distributions at 72, instead of taking the money out and paying tax, if you give it directly to a charity, you can count that towards your required distribution. So an example, it's called a Qualified Charitable Distribution, QCD.
Ooh, another acronym.
Yes. And this Qualified Charitable Distribution states that if it goes directly to that charity, and I don't take possession of the money, since the charity is a nonprofit, and it has to actually be a registered nonprofit,
right,
they then get to keep the tax in a sense. And so an example would be, let's say I have a $10,000 required distribution for a year, and I was already going to be giving $2,000 to a charity. If I would have taken the $10,000 out, paid my tax of 20%, and then tried to pay the charity,
right,
I have less money.
Yep.
If I have a $10,000 RMD, and I already know I'm going to give $2,000 to charity, if I give it directly from there, they'll get the full $2,000. I owe no tax on the $2,000, and the $8,000 that's left is the only thing I'll pay tax on. So I save taxes that way.
This is probably a lot more beneficial now with the standard deduction being so high,
right?
Because most retirees, they could have, if they were, say, doing a QCD and giving it to a church or whatever, then they could have itemized that and it would have been fine. But now everyone almost is going to take the standard deduction anyway. Not everyone, but a lot of people. So to do this, QCDs, you're taking it off the top part instead of down in the middle of your tax return.
Yep. And there's limitations to the amount and stuff. But for most people, this is the most efficient way from a tax standpoint to give to charity.
Can you give your entire RMD, if it fits within those limits, to charity and get those?
Not only that, you can give more than your required distribution to charity and still take the qualified charitable deduction. Yeah. So you can give less than, equal to, or more than, as long as you fit the parameters of the QCD. So that's another tax strategy within RMD. So you can reduce it ahead of time, or if you have the required distributions, you can give portions of it to charity, and that would reduce the taxes owed.
So I want to go back to loopholes.
Yes.
I think loopholes are a very sticky topic.
Oh, yes.
In especially when it comes to RMDs. But you talked a little bit ago about original owner as the term.
Yes.
So like someone who originally maybe had the account or whatever. What do you mean by that, and how does that impact RMDs and passing them, or IRAs and passing them along or whatever?
So a 401k's retirement plan, it's only for the person working at the company, right? I don't have a 401k for my wife at my job. She can have her 401k at her job, but each 401k is tied to one person.
On Friends, Phoebe called that a 401k.
401k.
Yeah.
The same is true with an IRA. That's short for individual retirement account.
Individual,
IRA.
One person.
And so because it's always tied to one person.
Tied to a social security number, right?
Tied to, one person.
You have one.
Yes. And so you can have multiple IRA accounts, but it's only one person can own it.
Yeah.
And so at that point, that owner is the one that's contributing into that account, whether it's a 401k or an IRA. Money's being added into it, and it's being added into it for your benefit. So that's where all these original or normal rules for the RMD are for you. 72 years, all that stuff are for you. Now, if you pass away prior to fully depleting that account, you can name beneficiaries on that account, and that account then goes to and becomes owned by whoever your listed beneficiary is. If it's your spouse, there are rules that allow them to just absorb it into their IRAs. They can make it theirs.
Right.
All right. And so if a spouse has the ability to take that and there's no limits or anything like that, the spouse can say, okay, that 401k or that IRA is now mine. Yep. And so the rules then are now my rules. So when I turn 72, all that. If I'm not the spouse and I'm a kid or a sibling or just a friend who got listed as a beneficiary, it becomes an inherited IRA account because I inherited it from somebody else. It was not originally mine. An inherited IRA has some fun rules. Yeah, 72 does not apply to inherited IRA. In fact, the new rules.
Oh yeah, they just changed that with
rules,
the CARES Act.
Brand new. Yes.
CARES Act. We talked about it.
Yes. And so the CARES Act are one thing, but the Secure Act is where a lot of these changed.
That's what I meant.
Yes. The CARES Act did have something to do with it, though, because they canceled all RMDs for this year, including inherited IRAs.
Oh,
so the CARES Act said for 2020, because of everything going on with COVID-19 and everything, nobody has to take anything out if they don't want to.
But Secure Act of 2019.
Yes.
2018. Late 2018. 2019.
The end of 2019.
Yes.
The Secure Act of 2019 said that any new inherited IRA, so from January 1st, 2020 on, if you inherit an IRA, whether it's a Roth IRA or a traditional IRA, because anybody who inherits it does have required distribution, even if it's tax-free growth money, because they don't want tax-free growth forever, get that out of there.
No free lunch.
They say you have 10 years to get all that money out.
And pay taxes on it.
On the withdrawals.
Over those 10 years.
Yeah, if it's a traditional IRA.
Yes.
So for 2020, you have to take all the money out in 10 years.
Okay.
And the rule is very open. You have 10 years to get the money out.
You can take
they
it
don't
out
say you could do
the first
1/10 every 10
last
years.
year, or in between.
You could say, I want 1% this year, 7% in 1 year, 47% another. It doesn't matter.
Well,
as long as by the 10th year, it's zero.
So planning this out with your advisor, you'd probably look at what your income and tax rates are now versus what, you don't really know for sure. Some people do, but versus what you anticipate them being in the future, and you would plan the most tax advantageous way of getting it out.
Yes. Yep. And, if it's a small account, let's say you get a $100 IRA for whatever reason. You may just say, I'm just going to take it now. The taxes is going to be minimal. It doesn't really matter.
Yeah.
So, depending on what it is, but if you get a $2 million IRA, man, you really want to plan that out because that could have a big tax impact. And so this 10-year rule gives a lot of flexibility, but it causes a lot of problems.
Yep.
For instance, if a trust was going to be receiving this IRA with a trust beneficiary taking the required distributions only, the wording of that trust could actually force them to wait till the 10th year and then have to take it all out because it won't let you touch it prior to that. So it did cause a lot of problems. I say all that, if you already have an inherited IRA, you are still on the old rules, which is you have your life expectancy and a required distribution every year.
Right.
So you can actually stretch out that IRA for a long time.
Stretch IRA.
That's what they call them. Yep. Because you're stretching that tax deferred growth even though you're not the original owner.
Yeah, this is a generally pretty unfavorable rule for individuals.
Yes. So what it did is it shortened the time frame it takes the IRS to get that tax money.
It also shortened the amount of time your money has to grow.
Yes. And the reason they did that is it offset some of the other Secure Act provisions. It enabled them to show income coming in where they were giving benefits other places.
Right.
Now, I say all that applies for people who are not eligible beneficiaries.
Whoa. So this sounds like another term I think we're probably going to want to define.
Yes. And
eligible beneficiary, what is that?
Yeah. So just to make it even more confusing, if you inherit an IRA and you are an eligible beneficiary, that would be a surviving spouse, which I talked about, a minor child, someone who is chronically ill or a disabled person, or someone who is within 10 years in age of the person who is deceased. Those are considered eligible beneficiaries.
Gotcha.
These people can then do the RMD rule the old of the past.
A minor child as opposed to a major child?
Yes. And so, they haven't quite broken through yet. Maybe their fastball isn't very good. So minor being under the age of majority,
right.
and each state has a different age for that. But for instance, we'll take them as an because they have some extra rules on top of everything else. So let's say a 4-year-old kid inherits $1 million. All right?
Wow.
Yeah, that 4-year-old has no clue he's going to go out and buy a bunch of, like dinosaurs or something and like spend all his $1 million, right? If it's my kids, it's like a whole bunch of, I don't know, what are those things called? They're like spin and they hit each other. I don't even know. It's a whole fun game. We'll just say Pokemon.
Okay, there you go.
I just know what that is. So a 4-year-old gets it. They obviously have no way of managing this $1 million.
Challenge.
Right?
Maybe you didn't when you were 4.
I buy a lot of bubblegum, I guess. But the rule says, okay, from 4, we're in Ohio here where we're recording, so 18 is our age.
Yep.
From 4 to 18, you have required distribution, and it's off your life expectancy. So it's really small, because your life expectancy from 4 till 115 or whatever, it's a very small withdrawal.
Yeah.
So they take these required distributions. When they hit 18, that 10-year rule starts. Because at that point, they say, hopefully you've had some counseling. Hopefully you have some people lined up to help you. But at 18, you have 10 years from 18 to 28, the rest of the money has to come out.
Gotcha.
The RMDs stop. You just have to get those out for 10 years. And so that's kind of their rule. Everybody else has just the 10 years. So if you're a disabled person, chronically ill, a surviving spouse, like I mentioned, your spouse then falls under their own rules, or someone within 10 years. So let's say it's 2 siblings, and we're 3 years apart. If I inherit it, I just have my RMDs, and I'll take it for my life expectancy because I'm within. They say you're within the same range as that other person,
right?
And so, so we talked through the 10-year rule. We talked through who is eligible for all those things. I think we need a break.
Oh, good. My head is spinning. Josh, this is why I talk to you about my questions about this stuff, because I'm like very, very high level. So, because I'm so high level and the weeds of this stuff confuses me and I talk to experts like you, I'm going to do what I do best and make Josh laugh.
All right.
So,
I'm ready.
Dad joke of the week. Get in my handy-dandy book here. What is the best part about Switzerland?
Switzerland. Well, I don't know. I don't think I've ever been there.
Well, the flag's a big plus.
A big plus. Because it is a giant plus.
It's a big plus. So, side note, we went on a motorcycle trip last week. My uncle and my cousin and my dad and I went down to North Carolina, and there's this little place in the mountains. Really twisty, beautiful roads for motorcycles. It was a great time. Everyone was safe. We all made it back. But there's this little place. It's like a chalet in the mountains called Little Switzerland.
Oh, yeah.
And we went and had lunch there, and it gets your little Switzerland vibe. It's not like the Alps, but it's pretty darn close for America anyway. It's decent mountains for the East Coast. And it was beautiful. Good lunch. I had a smoked trout, caught around there, club sandwich. Oh, so good.
Smoked trout. I love trout.
Seriously.
It's a good fish.
It's great. We don't have it around here much.
Flaky. There's I used to go actually trout fishing with my grandpa up near Sandusky area, which was so much fun. Fly fishing, which is a whole different way of fishing.
I've never
it's
done
so
that.
Fun. Challenging.
That sounds like
fun.
RMDs. That sounds hard.
It is challenging, but it was a lot of fun. So I have really fond memories of that, and then eating the rainbow trout that we would catch up there.
So now we know who needs to take an RMD,
Yes.
but when do you take it?
Okay. So, like I said, the current rule is kind of the default is 72. If you were already taking an RMD, so let's say you were 70 and a half last year, guess what? Unfortunately,
year and a half,
you
you
got
have
to take
to
it.
take-
Yep.
yeah.
They don't retroact anything. They don't care. So you got to take it out. The IRS doesn't put a time frame. They just said by 12/31. So you don't have to do it on your birthday or on any certain day. You have the whole time. So most people either say, you know what, I'm just going to treat it like a monthly income and just take a portion out every month. Others say, you know what, since it's tax-deferred growth, I'm going to wait till the end of the year and get as much tax-deferred growth as possible. It doesn't matter. As long as it's done by the end of the year, you're done.
So if your money is in a traditional, I'm thinking kind of traditionally equity-looking account, and there would probably be potential optimum or not optimum times in a market cycle to do that, right?
Yeah, so a good example is actually the last couple of years. So the end of 2018, if you remember back a couple of years, we saw a 19% drop at the end of the year.
Correct.
So what that did is it brought everybody's account values down when they evaluate your required distribution. So on 12/31, account values were down. And then at the beginning of the next year, the values caught back up. The market caught back up to where it was and continued on to new highs. In 2019, the market was up 30-some% or whatever. And so that was a plus for anybody taking required distribution because you got a low valuation.
Low,
your calculation was low, and then all of a sudden your account value grew very quickly. And if you waited till the end of the year, your percentage of withdrawal was lower than what the calculation originally was because you're going off a higher value. Reverse that. End of 2019, you had a high ending value and then a 35% drop in the stock market. So if you were planning on taking it in March, your percent withdrawal would be a lot higher than the calculation because your value. So, if you look historically, 3 out of every 4 years are positive in the stock market. That's part of why people wait to the end of the year to take it, is 3 out of every 4 years it paid off. Now, you're talking, in most years, probably just small little difference between the percentage calculation on the two. But in general, we always tell our clients, if you need the money, that's the best time to take it. Because you have to take it out by the end of the year. Trying to time it in and out and frustrating yourself on that, it's just a waste of time.
If you have the flexibility and it's a substantial swing, that might be an opportunity. But generally speaking.
Yeah. And, a rule of thumb is plan on taking it at the end of the year. And if an opportunity arises earlier, then go for it. If you hit an all-time high in July, you may say, you know what, I don't know what the rest of the year is, but I at least know where I'm at right now, and it's better than the beginning of the year. I'll take it now. So, there's really not a bad time to take it because you have to do it. The bad time to take it is on 1/1 of the following year because you missed it. And we're going to talk about the tax consequences of missing in a minute.
Oh, so we've already talked a lot about loopholes, about exceptions, about areas that just, are there to confuse you. Are there any more, or can you just rehash a couple of those just to be sure we understand as we go forward?
So one of the ones we didn't talk about is, for instance, let's say I have multiple IRAs. So let's say I have a traditional IRA I added some pre-tax money into on my own. Then I have a rollover IRA because I had a 401k and I pulled it out. And then let's say I started a new job and I have a new 401k. So I have 3 tax-deferred accounts that all have required distributions. Do I have to take a little bit out of each of them? How's that work? The IRS says, because they love making things exciting and very straightforward, if you have IRAs, you have to calculate each one so you know how much comes out, but you can take it out of any of them, all of them, however you want to do it. They don't care. IRAs, they look at them all as a big bucket of stuff. 401ks, though, each 401k, the required distribution has to come out of that 401k.
Okay.
So that's one of the rules they have. So, if I have a 401k and I have a $5,000 RMD and I have an IRA and a $5,000 RMD, I can't take 10 out of one of those. The 401k has to have 5, and then all the IRAs together have to have 5 out. So
would this be an opportunity that if you had a handful of different IRAs, you worked a bunch of different jobs, whatever, they're just kind of sitting there, you could strategize how each account was invested so that you calculate your RMDs based on totals, just like you should, but you can determine which one at which point to take your RMD out of.
Yes, definitely.
If they're all the same.
Yeah. So if, let's say one's a equity that has a high growth, in a good year like 2019, I'm pulling my RMD out of there because that's where my growth came from.
But in a down year, you take it out of a cash or fixed income
very
IRA.
conservative account. Yep. Yes, definitely. And the other thing with that too, and this is another exception, age 72 is when you have to start RMDs. If you're still working, your 401k at the company you're working at is suspended until you end your work there. And so if I'm working at 75, my 401k account does not have required distribution unless, because, there's exceptions to the exception. If I'm a 5% owner or more in the business, I have an RMD no matter what.
Now, are there work requirements? So, does it matter if you're full-time or part-time?
No, as long as you're employed. For that 401k company,
so it might be advantageous if you could stay on as a consultant. I'm using air quotes on a podcast.
Consultant, as long as you're still eligible for the 401k plan. Because if I leave employment and I'm no longer eligible, but I'm working as a consultant, if I'm not within what's considered an employee there, then I wouldn't count for that. But you're right. If I'm part-time there, just working a day a week.
As long as you're qualified for the plan.
Yes. And there's probably some IRS rulings that I'm not familiar with. I'm sure they've hashed out exactly. People probably try to game the system, working one day a year or something just so they don't have to touch it. But in general, if you're legitimate employed, whatever that is, you can postpone your required distributions.
Gotcha.
Now it's until the year you retire. So that's the other thing. Some people say, I want to retire at the end of the year on 12/31. Well, guess what? If you retire in that year, your required distributions due. So
that's crazy.
1/1 is a better time to retire
exactly.
when looking at that thing. And so another planning opportunity is, if I know I am going to work for a little while after 72, maybe actually rolling some of my IRAs into the 401k.
Yeah.
If your company plan allows that, would reduce or eliminate their RMDs as well. Yep. Because even if I'm employed, the 401k is the only one that allows that exception.
So if you're planning on working past 72 and you have, but you're not there yet,
and I have an old
rollover, see if you can roll it into your new plan so that when you continue to work, you don't have to take those RMDs.
Yeah. Just a way of postponing a little while.
That's a really good plan.
Strategies. Now, the downside is 401ks do not allow QCDs. So at some point, if you're wanting to do charity, you'll have to get it back into an IRA, a rollover IRA.
And then you'd have to take RMDs.
Yep. And so there's a lot. Like I said, there's a lot there. That's, again, why we say financial advisors are very helpful, especially going through some of these complicated processes of retirement.
So how would you recommend someone keeping track of all of this? I mean, I just from the outside looking in, I work in the industry, and this is still a lot to comprehend and stuff. So how would you recommend most people handle this?
The first thing I say is, don't wait till the last minute. Start planning ahead. And so, what I say, a good financial advisor will be running some of these scenarios prior to 72 and saying, okay, let's look at some tax planning options before that. So we talked about doing a conversion, moving money from your rollover or traditional IRA into a Roth IRA. You don't want to do that when required distributions are already there. You want to do it prior to that. So planning ahead is key. So thinking through those things before they get there. And then obviously just having a plan, having a reason for what you're doing. Because if I know what each account is set up for and why it's there, you're going to have to pay a tax. I mean, the taxes are owed at some point. Just minimizing to what is the minimum amount of taxes I have to owe. And so I may have to pay taxes. I may have to take an RMD. Mm-hmm. That's okay if it fits in my plan, especially if I'm going to be living off some money anyways. If the RMD fits into that whole calculation, that's fine because I'm going to need that money to live off of anyways. Right. So just having a plan and sticking to it.
So we talked a lot about it, but this is an area where it's probably worth its weight in gold to work with someone who knows the rules, who knows how to plan ahead for this kind of stuff. So, Josh and I, we want to let you know that we're here for you. We're here to help. If you have any questions, don't hesitate to reach out. But also, just generally, working with a financial advisor is a huge asset in this kind of area of planning. So if you are curious to know more about what Josh and I do at Hickson Zucker Capital Management, check out the Invest With Us tab on our website. We'll link that below. We work with a team of credentialed, experienced colleagues that have worked alongside our clients for nearly 2 decades to help them achieve their financial goals, including planning required minimum distributions and tax planning, all of this stuff. And we can help you too.
So I think before we end, just to recap everything would be great. And so there's a lot we went through. Hopefully we were clear. If you have any questions, please email us. Yeah. We'd love to help you out. We can't give you financial advice on specific situations, but you just want clarification on these rules and stuff, more than happy to answer.
What's that email?
The email is hello@theinvesteddads.com. But review, 72 is when most required distributions start.
Yep.
If you inherit an IRA, you have 10 years, and I'm going to say if you inherit, meaning you're doing it now going forward, you have 10 years to get that money out, and you can strategically plan when to get that money out. And so those are the two big things I think for required distributions everybody needs to know. Yeah. Is that's the start point of 72, and if you inherit an IRA, you have 10 years to get that money out, and you can pick and choose how that works.
So as always, check out our free gift to you on our website, a brief list of 8 principles of timeless investing. These are overarching investment themes meant to keep you on track to meet your long-term goals. Check it out. It's free. Josh, how can people help us grow this podcast and continue to help people?
Yeah, make sure you subscribe, especially on Apple Podcasts. Leave us a review. Email us at hello@theinvesteddads. Not just questions, but any topics. So if this triggered something you'd like to know about, shoot us an email with the topic. We'd love to cover that in a future episode. And then share. If you think of somebody in your family or friend that is getting close to that age, and you thought, well, let's make sure they know everything that they need to about RMDs, share this with them. We'd love to help. As always, it was great. Hopefully you enjoyed this awesome topic. I know my wife, when I told her this was the topic a couple days ago, she said, she kind of rolled her eyes and said, I know nothing about that, and I don't want to. So hopefully she enjoyed that as well.
Yeah. Hey, thanks. Have a good week.
All right. Bye.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.